Why do you follow all the risk rules and still lose money? Why can you execute your plan perfectly for 3 days and then completely abandon it on day 4? Why does your friend with less knowledge and a simpler strategy make more money than you? Here's what nobody's telling you. The risk management you've been taught is designed for institutional traders with infinite capital and zero emotion. It doesn't work for you, not because you're doing it wrong, but because the rules you're following were never designed for the psychological reality of individual trading. There are 5 hidden rules that winners discovered through painful trial and error, that actually address how human beings manage risk in real market conditions, and they contradict almost everything you've been taught. I need to start by being completely honest with you about something. You're doing everything the books tell you to do. You're managing risk properly. You've got your stops in place. Your position sizing is calculated correctly. You're checking your risk-reward ratios before you enter. You're following the rules. And yet, you're still struggling. You're still experiencing drawdowns that shouldn't happen based on your system. You're still making decisions that sabotage your own plan, and there's this gnawing frustration that comes with that. This feeling of, what am I missing? What am I doing wrong? You can't figure it out. You watch other traders succeed, traders who seem to have less knowledge than you, less discipline, less sophisticated systems, and you start to wonder if maybe trading just isn't for you, if maybe you're missing some essential quality that successful traders have. But that's not what's happening. You're not missing some magical quality. You're not broken. You're not lacking discipline or intelligence. What you're missing is knowledge of the hidden rules, the rules that operate beneath the surface of conventional risk management. The rules nobody teaches because they're psychological rather than mechanical. Everyone teaches risk management as if it's purely mechanical. Put your stop here based on market structure. Risk this percentage based on your account size. Aim for that ratio based on statistical edge. It's all formulas and calculations and technical placement. And that approach treats you like a robot. It completely ignores the fact that you're a human being with emotions, with biases, with psychological patterns that determine whether you can actually execute those mechanical rules consistently. And here's the reframe that changes everything. The rules everyone focuses on, the ones about stop placement and position sizing and risk-reward ratios, those are necessary. You need them. But they're not sufficient. They're the visible rules. But there are 5 hidden rules that operate beneath the surface. Rules about psychological state, about contextual awareness, about behavioral consistency. And winners don't just follow different rules. They follow rules at a different level of depth. They're playing a different game than you are. You're playing the mechanical game, trying to get the technical details right. They're playing the psychological game, managing themselves so they can execute the technical details consistently. And that's what this video is about. I'm going to share with you the 5 hidden risk rules that winners follow, most of them unconsciously. Rules they discovered through years of painful trial and error. Rules that completely changed how I approached risk management and transformed my results. You're going to understand why conventional risk management fails for most individual traders. You're going to learn how to integrate psychological reality into your risk framework. You're going to discover the specific shifts that make textbook rules actually work in practice. And you're going to get immediate practices you can apply starting with your very next trade. But more than that, you're going to experience emotional relief. That constant confusion about why you keep violating your own plan, it's going to dissolve. You'll finally understand why other traders succeed with quote-unquote worse rules than yours. Why perfect mechanical execution isn't enough. And most importantly, you'll know exactly what to fix. Because risk management isn't about controlling the market. It never was. It's about controlling your response to uncertainty. The hidden rules aren't about where you place stops or how much you risk. They're about creating psychological conditions where you can follow any risk system consistently. Master the hidden rules, and the visible rules become easy. Let me tell you a story. A personal story about the most frustrating period of my trading career. I'd spent months developing what I thought was the perfect risk management system. I'm talking about real work here, every parameter optimized. Stop losses placed according to volatility measurements. Position sizing calculated based on the Kelly criterion. Risk-reward ratios never below 2.5 to 1. I was meticulous about this. I backtested it extensively, thousands of trades in historical data. And the system was profitable. The math worked. The logic was completely sound. I was ready to deploy it in live trading. For the first 3 weeks, I executed it perfectly, every single trade by the book, every stop exactly where it should be based on my calculations, every position size calculated to the penny, every entry meeting my exact criteria, and I was slightly profitable. Nothing amazing, nothing to write home about, but consistent. Small gains adding up. The system was working exactly as designed. Then came week 4, and I don't even remember what triggered it. Maybe it was a losing streak. Maybe it was stress from something happening outside of trading. Maybe I was tired. I honestly don't know. But I started making tiny adjustments, moving a stop just a little bit to give a trade more room, taking a trade that was almost but not quite a valid setup, sizing up slightly on a trade I felt really good about. And here's the thing. None of these violations seemed significant at the time. I wasn't doing anything crazy. I wasn't abandoning my system. I was still roughly following it. The deviations were small, but they compounded. One small adjustment led to another. One slightly oversized position led to the next one being slightly bigger too. Within 2 weeks, I'd given back all my gains and more. And the worst part, the part that really ate at me, was that I couldn't pinpoint exactly where I'd gone wrong, because I hadn't made any big, obvious mistakes. I hadn't had a single catastrophic trade. I just had a lot of small deviations that added up to a significant loss. And that's when I realized something crucial, something that changed my entire approach to risk management. My system was perfect mechanically. The math was right. The logic was sound. The backtests proved it worked. But it had zero accommodation for me being human. It assumed I would execute like a robot regardless of my emotional state, regardless of context, regardless of what happened in previous trades. The hidden rule I was violating, the one I didn't even know existed, was this. You can't separate risk management from self-management. My system managed trade risk beautifully. It calculated exactly where stops should be, exactly how much to risk, exactly what ratios to target. But it didn't manage psychological risk at all. It didn't account for the fact that my ability to execute the system changed based on my state. And that's when I started discovering the hidden rules. Rules that had nothing to do with stop placement or position sizing formulas. Rules about how to manage myself so I could actually execute the system I'd built. Let me give you another way to think about this, another story that might make this click at a deeper level. Imagine 2 traders watching the same coin flip experiment. The coin is fair, 50-50 odds, and it's landed on heads 5 times in a row. Both traders are standing there watching this. Both of them understand probability. Both of them know that coin flips are independent events. Both of them know that the next flip is still 50-50, regardless of what happened before. First trader looks at this situation and thinks it's due for tails. 5 heads in a row is unusual, statistically unlikely. So the next flip should probably be tails to balance things out. I should bet on tails. Second trader looks at the same situation and thinks the pattern is completely irrelevant. It's still a 50-50 flip. The coin doesn't remember what it did before. I'll bet based on my system, not based on the recent pattern. Who's thinking more rationally? Obviously the second trader, right? The first trader is falling for gambler's fallacy, the belief that past independent events influence future independent events. Now translate this exact scenario to trading. You've lost 5 trades in a row. All of them were valid setups according to your system. All of them were executed properly. You followed your rules perfectly. It's just variance, just probability playing out. Your next valid setup appears. It meets all your criteria. First trader thinks I'm due for a win. 5 losses in a row is unusual. I should size up on this one to make back what I lost. The wins have to come eventually. Second trader thinks the previous trades are irrelevant. Each trade is independent. I'll execute this trade according to my rules regardless of recent results. Who's managing risk better? You'd say the second trader, right? They're thinking probabilistically. They're not falling for gambler's fallacy. They understand independence of events. But here's where it gets complicated. Here's the hidden rule that most traders completely miss, and why conventional advice fails. The second trader is right mechanically. Each trade is independent probabilistically. The market doesn't know or care what happened in your previous 5 trades. But the second trader is wrong psychologically. Because humans aren't probability machines. We're not computers running algorithms. Your emotional state after 5 losses is completely different than your emotional state after 5 wins. Your capacity for rational execution has been compromised. Your confidence is shaken. Your fear is elevated. Your desperation might be creeping in. And all of that affects your ability to execute the 6th trade properly, even if it's a perfect setup. The hidden rule, the one that winners understand intuitively, is this. Mechanical independence doesn't equal psychological independence. You need to adjust your risk based not just on market conditions, but on your psychological condition. So how do you know when to follow the mechanical rules and when to adjust for psychological reality? How do you navigate this contradiction? That's where the 5 hidden rules come in, and I'm going to break them down for you one by one. Hidden rule number 1. Risk management is state management. Everyone teaches risk management as if it's about the market. Where to place your stop based on market structure. How much to risk based on account size and volatility. What ratio to aim for based on your statistical edge and expected value. It's all market-focused, all external. But here's what they're missing. Here's the truth that changes everything. The biggest risk in trading isn't market movement. It's your psychological state when market movement happens. You can have perfect stops, mathematically optimal stops placed at exactly the right technical levels, and still blow up your account if you're in the wrong emotional state when those stops get hit. Because in that state, when you're stressed or desperate or scared or overconfident, you'll override the stop. You'll move it just a little bit, or you'll revenge trade after it hits, or you'll freeze and not take the next valid trade because you're too scared. The stop didn't fail. Your state failed, and your state determined whether you could execute the stop properly. So here's the shift you need to make. Before you calculate where your stop should be based on market structure, assess where your psychology is. Are you calm or stressed? Are you coming off a series of wins or a series of losses? Are you trading to make money? Or are you trading to prove something? Are you feeling confident in a healthy way or overconfident in a dangerous way? Your risk management rules need to flex based on your state. And this is hard for traders to accept because it sounds like you're letting emotions control you. It sounds weak. It sounds like you're making excuses, but it's the opposite. You're managing the actual risk, the real risk, the risk of psychological deterioration that leads to catastrophic decisions. Not just the theoretical risk of market movement. After losses, you need to cut position size, even if the market setup is absolutely perfect. When you're stressed about something in your life outside of trading, you need to take fewer trades, even if opportunities exist. When you're feeling desperate, when you need a win, you need to step away entirely, even if you quote-unquote should be trading. And here's the paradox that's going to mess with your head. The traders with the strictest mechanical rules often blow up the fastest, because they try to follow those rules regardless of their state, and eventually their state forces them to violate the rules catastrophically. They hold it together, hold it together, hold it together, and then they snap. The traders who adjust their rules based on their state, who are flexible and self-aware, they stay in the game longer. They perform better over time, not because they're more disciplined, but because they're more honest about their limitations. Hidden rule number 2. Risk per trade is meaningless without risk per state. You've been taught to think about risk per trade. Risk 1% per trade, risk 2% per trade. Calculate your position size based on your stop distance and your account equity. This is standard advice. It's in every trading book. But this framework ignores a critical reality. The risk of any individual trade compounds or diminishes based on the trades around it, based on the context it exists in. Losing 1% on a trade after 4 wins feels completely different than losing 1% on a trade after 4 losses. Mathematically, it's identical. 1% is 1%, but psychologically, they're opposite experiences. After 4 wins, you can absorb that 1% loss easily. Your confidence is intact. Your emotional reserves are full. You can immediately take the next trade without baggage. After 4 losses, that 1% loss might break you. It might be the thing that triggers revenge trading or causes you to freeze up. Your emotional reserves are depleted. Your confidence is shaken. That same 1% has a completely different psychological impact. So here's the shift. Instead of thinking risk per trade in isolation, think risk per sequence. How much can you lose in your current psychological state before your execution starts to deteriorate? If you're calm and confident, if you're well-rested and emotionally stable, maybe you can handle 3 1% losses in a row before you start making emotional decisions. If you're stressed or tired or on a losing streak, maybe you can only handle 0.5% loss before you start deviating from your plan. Your position sizing needs to account for this. Here's how to implement it practically. Start every sequence, every period of trading after you've taken a break with your standard position size. Let's say that's 1%. After each loss in that sequence, reduce your size. After each win, keep it the same. Don't increase it, so if you lose the first trade, the next trade is 0.5%. If you lose that one too, the next trade is 0.25%. You're ratcheting down your exposure as the psychological pressure builds. Why does this work? Because it protects you during the exact moments when you're most vulnerable. When losses are accumulating and your emotional state is degrading, it keeps you in the game psychologically even when variance is going against you. It prevents the death spiral where losses lead to emotional decisions, which lead to bigger losses, which lead to catastrophic decisions. Hidden rule number 3. The stop loss is not where you exit. It's where you admit. Everyone teaches stop losses as risk management tools. They prevent catastrophic losses. They limit your downside. They protect your capital. You place them according to market structure or volatility or some technical formula. And all of that is true on the surface. But here's the hidden truth that nobody talks about. A stop loss is not primarily about protecting your capital. It's about protecting your psychology from the toxicity of being wrong and not admitting it. The real function of a stop, the deeper purpose, is this. The stop isn't where you exit to prevent further financial loss. It's where you admit your initial thesis was wrong. It's a psychological tool disguised as a financial tool. Think about what happens when you move a stop. You're not just increasing your financial risk, you're practicing denial. You're training your brain that being wrong is intolerable, that you need to avoid admitting error at all costs. You're reinforcing the pattern of avoiding discomfort instead of accepting reality. And that pattern destroys you. Not because the individual moved stops necessarily cost you money, though they often do, but because you're building a neural pathway that makes psychological honesty impossible. You're teaching yourself to lie to yourself, to rewrite reality instead of accepting it. Over time, this makes you incapable of cutting losses at all. Because every loss requires admitting you were wrong, and you've trained yourself that being wrong is unacceptable. So here's the shift. Think of your stop as your integrity threshold, the point at which you pre-committed when you were thinking clearly to admitting you were wrong. Moving it isn't a tactical adjustment. It's a character violation. It's breaking a promise you made to yourself. This reframe makes stops sacred. You'll protect them not because you're afraid of losing money, though that's part of it, but because you're committed to being the kind of person who admits error immediately, who faces reality instead of avoiding it. And when stops become about integrity instead of just about money, you stop moving them, because you can rationalize losing a bit more money. But you can't rationalize violating your own integrity. Not easily. Hidden rule number 4. Risk-reward ratios are backwards. You've been taught to aim for high risk-reward ratios. 2-to-1 minimum. 3-to-1 is better. The logic makes perfect sense. Risk less to make more. Mathematics says if you risk 1 to make 3, you only need to win 34% of the time to break even. But this framework creates a hidden problem that undermines everything. It makes you optimize for outcomes you can't control instead of behaviors you can control. You can't control whether the market gives you a 3-to-1 winner. You have no control over that whatsoever. The market is going to do what it does. You can control whether you follow your rules, whether you execute your plan properly, whether you manage your risk according to your system. But by focusing on risk-reward ratios, you're unconsciously making the outcome more important than the execution. And that subtle shift in focus destroys your trading, because now you're measuring success by something you can't control. And when you can't control the metric you're optimizing for, you start doing irrational things to try to control it anyway. You'll hold losers too long, hoping they turn around and give you an acceptable ratio. You'll cut winners too early to lock in good ratios before they disappear. Your decisions become outcome-focused instead of process-focused. You're trying to force the market to give you what you want instead of responding to what the market is actually doing. So here's the shift. Instead of risk-reward per trade, think execution quality per trade. Your only job, your only measure of success, is perfect execution of your plan. If you execute perfectly and get stopped out, that's a win, even though it's a financial loss, even though it hurts. It's a win because you did what you were supposed to do. If you execute poorly and make money, that's a loss. Even though it's a financial gain, it's a loss because you violated your process. This sounds like mental gymnastics. It sounds like you're lying to yourself to feel better about losing, but it's not. It's recognizing that in a probabilistic game, the only thing you actually control is whether you play correctly. You can't control whether any individual trade wins, but you can control whether you follow your plan. And if you follow your plan consistently over thousands of trades and your plan has a genuine edge, you will make money. The math guarantees it. But if you focus on outcomes, if you optimize for risk-reward ratios instead of execution quality, you'll sabotage your edge. You'll make adjustments that feel rational in the moment, but destroy your results over time. When you optimize for execution quality instead, when you make that your only measure of success, everything changes. You follow your plan regardless of outcome. You don't hold losers hoping they improve. You don't cut winners fearing they'll reverse. You just execute. And paradoxically, this improves your actual risk-reward over time. Because you're not sabotaging your edge anymore. You're letting your system work the way it was designed to work. Hidden rule number 5. The best risk management is not taking the trade. Everyone focuses on what you do after you enter a trade. Where's your stop? How much are you risking? What's your target? What's your management plan? And all of that matters, but it's secondary. The most important risk decision happens before entry. Should you take this trade at all? And I'm not just talking about whether it's a valid setup according to your system. I'm talking about whether you're in a state where you can execute the trade properly. Most losses, the ones that really hurt, the ones that turn into disasters, they come from trades you shouldn't have taken. Not because the setup was invalid, though sometimes it was, but because you weren't in the right state to execute it properly. You were stressed. You were on a losing streak. You were desperate. You were trying to prove something. You were trading to feel productive instead of trading to make money. And in that state, even a perfect setup becomes a trap because you can't execute it properly. So here's the shift. Add a psychological filter to your trade selection process. Before you ask, is this a valid setup according to my system? Ask, am I in a state where I can execute this trade properly? If you're on a losing streak, the answer is probably no. If you're stressed about something outside of trading, the answer is probably no. If you're desperate or trying to prove something or feeling like you need to trade, the answer is definitely no, even if it's the perfect setup, even if it meets all your criteria, even if you're quote-unquote missing opportunity. Because opportunity only exists if you can execute it properly. A perfect setup that you're going to sabotage with emotional interference isn't an opportunity, it's a trap. It's a setup for psychological damage that will affect your next 10 trades. The traders who make the most money don't take the most trades. They're not the ones constantly in the market. They're the ones who take the trades where they can execute perfectly, and they ruthlessly eliminate the trades where they can't. They're willing to sit on their hands for hours, for days if necessary, waiting for both conditions to align. A valid market setup and a valid psychological state. And when both exist, they execute flawlessly. Now let me give you some practices you can implement immediately. Starting with your very next trading session. These aren't complicated, they're simple, but they integrate the hidden rules into your actual trading. Practice 1. The state check protocol. Before every trading session, before you even look at charts, rate your psychological state on a scale of 1 to 10. Be honest. Don't rate yourself based on where you wish you were or where you think you should be. Rate yourself based on how you actually feel right now. 1 through 3 means don't trade. You're too compromised. Your execution will be terrible. Any trades you take will likely be disasters. 4 through 6 means trade with half your normal position size and take half your normal number of trades. You're functional, but not optimal. Protect yourself. 7 through 10 means trade normally. You're in a good state. You can execute properly. This forces you to acknowledge your state before entering the market, and it gives you a clear framework for adjusting your risk based on that state. Practice 2. The sequence tracker. Track your trades in sequences, not individually. A sequence starts when you begin trading after a break and ends when you stop trading and step away. Here's the rule. After 2 losses in any sequence, cut your position size by 50%. After 4 losses in any sequence, end the sequence. Take a break. Walk away for at least an hour, preferably the rest of the day. This protects you during variance. It prevents the death spiral. It keeps you in the game psychologically even when probability is going against you temporarily. Practice 3. The integrity stop. When you set a stop, don't just mark a price level. Write down why it's there. Write the actual sentence. I will be wrong if price goes here because this market structure will be invalidated. Or whatever your specific reason is. Now that stop is not just a price level, it's a statement of wrongness. Moving it means rewriting reality, means admitting you're willing to lie to yourself. You won't do it casually. Practice 4. The execution journal. After each trade, win or loss, rate your execution quality from 1 to 10. Did you follow your plan perfectly? Were you emotionally neutral during the trade? Did you make any adjustments based on fear or hope or any emotion? Track this separately from your profit and loss. Your goal is 8+ execution quality on every trade regardless of outcome. Make this your primary metric. Make this what you optimize for. Over time, you'll notice that your profit and loss follows your execution quality. Perfect execution leads to profit. Poor execution leads to loss. But if you track P and L instead of execution, you can't see this clearly. Practice 5. The pre-trade filter. Before you enter any trade, ask yourself one simple question. Am I taking this trade to make money or to solve an emotional problem? If you're trading to make back losses, that's solving an emotional problem. If you're trading to prove you're not scared, that's solving an emotional problem. If you're trading to feel productive or to avoid feeling like you're missing out, that's solving an emotional problem. Only take trades where your only motivation is executing your edge, where you're purely focused on following your plan because you believe in it over thousands of trades. If you're trading for any other reason, don't take the trade. Wait for one where your motivation is pure. Let me bring all of this together now and show you the complete picture of what we've covered. We started with a question. Why do you follow all the risk rules and still lose money? Why can you execute perfectly for 3 days and then abandon your plan on day 4? Why do less knowledgeable traders make more money than you? The answer is that the risk management you've been taught is designed for robots, not humans. It's mechanical. It ignores psychology, and psychology is what determines whether you can execute the mechanical rules consistently. I shared my story of the perfect system that failed, the system that worked beautifully in backtests and in live trading for 3 weeks, and then fell apart in week 4 because it had no accommodation for me being human. That's when I learned hidden rule number 1. You can't separate risk management from self-management. Then I gave you the coin flip parable, the story that shows why mechanical independence doesn't equal psychological independence, why you need to adjust your risk based on your psychological condition, not just market conditions. And then we broke down the 5 hidden rules one by one. Hidden rule number 1. Risk management is state management. Your biggest risk isn't market movement. It's your psychological state when market movement happens. Assess your state before calculating your risk. Hidden rule number 2. Risk per trade is meaningless without risk per state. The same loss has different psychological impacts depending on context. Think in sequences, not individual trades. Adjust your size as sequences progress. Hidden rule number 3. The stop loss is not where you exit. It's where you admit. Stops are psychological tools for practicing honesty, not just financial tools for limiting loss. Make them about integrity, not just about money. Hidden rule number 4. Risk-reward ratios are backwards. Optimize for execution quality, not outcome ratios. You control execution. You don't control outcomes. Make execution your measure of success. Hidden rule number 5. The best risk management is not taking the trade. Opportunity only exists when you can execute it properly. Add a psychological filter to your trade selection. Only trade when both market setup and psychological state are aligned. And I gave you 5 practices: the state check protocol, the sequence tracker, the integrity stop, the execution journal, the pre-trade filter, all designed to integrate these hidden rules into your actual trading starting today. Now, I need you to hear this clearly. You are not failing because you don't know the rules. You're failing because you're following the wrong rules. The visible rules, the ones about stops and position sizing and ratios, they're necessary. You need them, but they're not sufficient. The hidden rules, the ones about state management and sequence awareness and psychological honesty and execution, focus and selective participation, these are what separate winners from losers. These are what determine whether you can actually execute the visible rules consistently. You don't need to be smarter. You don't need more discipline in the traditional sense. You need to manage yourself as carefully as you manage your trades. You need to integrate your humanity into your risk framework instead of pretending it doesn't exist. Winners aren't superhuman. They're not emotionless robots. They haven't eliminated fear or greed or hope or frustration. They've just learned to work with their psychology instead of against it. They've learned to adjust their risk based on their state. They've learned to be honest with themselves about their limitations. And that's what these 5 hidden rules give you. A framework for being human and profitable at the same time. For acknowledging that you have emotions and working with them instead of pretending you don't. If this video shifted how you think about risk, if you finally understand why following the textbook rules hasn't been enough, if something clicked for you about the psychological dimension of risk management, I need you to do something. Like this video. Hit that like button, because there are thousands of traders out there right now who are executing perfectly mechanically and still struggling, who think they're failing because they're not disciplined enough or smart enough. And they need to see this. They need to understand that they're following the wrong rules, not failing at the right rules. Leave a comment and tell me which hidden rule resonated most with you. Which one clicked? Which one made you think, oh, that's what I've been missing? I want to know. I read every comment and I want to understand which of these rules lands most powerfully for people. And subscribe to this channel if you want more content that addresses the psychological reality of trading instead of pretending you're a machine. Because we're going deeper. We're going to keep exploring how your mind actually works in the market, and how to build systems that work with your psychology instead of against it. The visible rules are everywhere. Every trading book covers them. Every course teaches them. But the hidden rules, the ones that actually determine success, these are what I'm here to share. These are what separate the 5% who make it from the 95% who don't. And now you know them. Now you have them. The rest is implementation. The rest is integrating these into your actual trading and watching your results transform.